This LOS is describe basic features of a fixed income security. Before we jump into this LOS, we'll just do a brief introduction to the reading, and which covers the following LOS as well. So, judged by total market value, fixed income securities constitute the most prevalent means of raising capital globally. A fixed income security is an instrument that allows governments, companies, and other types of issuers to borrow money from investors. Any borrowing of money is debt. The promised payments on fixed income securities are, in general, contractual legal obligations of the issuer to the investor. For companies, fixed income securities contrast to common shares in not having ownership rights. Payment of interest and repayment of principal, amount borrowed, are a prior claim on the company's earnings and assets compared with the claim of common shareholders. We've seen that in the equities section. Assets minus liabilities equals equity. Equity is a residual amount. Thus, a company's fixed income securities have, in theory, lower risk than the company's common shares. Okay? So among the questions that this reading addresses are the following. What set of features define a fixed income security, and how do these features determine the scheduled cash flows? What are the legal, regulatory, and tax considerations associated with a fixed income security, and why are these considerations important for investors? What are the common structures regarding the payment of interest and repayment of principal? What types of provisions may affect the disposal or redemption of fixed income securities? So, embarking on the study of fixed income securities, please note that the terms fixed income securities, debt securities, and bonds are often used interchangeably by experts and non-experts alike. Overview of a fixed income security. So a bond is a contractual agreement between the issuer and the bond holders. There are three important elements that an investor needs to know about when investing in a bond. One is the bond's features, including the issuer, maturity, par value, coupon rate and frequency, and currency denominations. These features determine the bond's scheduled cash flows and therefore are key determinants of the investor's expected and actual return. Number two is the legal, regulatory, and tax considerations that apply to the contractual agreement between the issuer and the bondholders. And finally, number three, the contingency provisions that may affect the bond's scheduled cash flows. And we'll see this in further LOS. Contingency provisions, the three common ones are callable. Bond could be callable, which is at the right of the issuer, or it could be puttable or convertible, and those are at the right of the bondholder. Okay? So contingency provisions that may affect the bond's scheduled cash flows. These contingency provisions are options. They give the issuer or the bondholder certain rights affecting the bond's disposal or redemption. And again, the three that we look at in the CFA is three contingency provisions are callable, puttable, and convertible. So continuing with the overview of a fixed income security and the basic features of a bond. On this and the next few slides and practice questions, we're going to cover more information about the issuer, maturity, par value, coupon rate and frequency, and currency denomination, and some introduction to some yields. Okay, so on this slide we're starting with the issuer, and again there's going to be more LOS and more information in further readings with regards to different types of issuers. Nevertheless, this is a introduction. So with regards to who issues bonds, one is supranational organizations such as the World Bank, IMF as well, and others, and we'll learn more about that again in further detail later on. Nevertheless, sovereign bonds, which are national governments such as United States or Japan, two of the largest issuers of bonds in the world. Government bonds, US is the largest, Japan is number two. Then we have non-sovereign local governments such as the state of Minnesota. So a Canadian province could issue bonds. States in the United States can issue bonds. So they're called non-sovereign government. We've got quasi-government entities that could be within a country, kind of government-related entities, so they're called quasi-government. Then, of course, we've got the corporations, companies, and special legal entities. So, quick note here, credit risk is inherent to all debt investments. Bond markets are sometimes classified into sectors based on the issue's creditworthiness as judged by credit rating agencies. Again, we'll see more about that later. So, whether it's AAA or, triple B plus, etc. These are the credit ratings by S&P or by Fitch or by Moody's, etc. So we can look at bond markets, we can look at it by geography, we can look at it by credit rating, we can look at it by maturity. There's different ways of analyzing bond markets, okay? So one major distinction is between investment grade and non-investment investment grade bonds, also called high yield or speculative bonds. Okay, by the way, this is a slide actually from a reading that comes up later on the fundamentals of credit analysis. Again, this LOS and this reading is just the introduction, so we're not going to cover everything in more detail, but because we're talking about the investment grade, the last point on the last slide was talking about investment grade and non-investment grade. That's an important enough subject that I thought I would bring this slide forward from the reading on fundamentals of credit analysis, just to give it 2 seconds. And so here we've got the investment grade ratings for Moody's, S&P, and Fitch, and we can see that's the cutoff for the investment grade. So for S&P and Fitch, triple B minus is the cutoff. If we go below that, so S&P and Fitch to double B plus, that's non-investment grade, that's junk, okay? And for Moody's, BA1 is non-investment grade or junk. So Moody's has a little bit of a different rating system. Their cutoff for investment grade is BAA3, okay? And then you can see here, this is in default, this lowest level with regards to Moody's and S&P and Fitch. But in general, the most important thing is understanding the cutoff between the investment grade and the junk, okay? So that's when a bond gets classified as non-investment grade or junk, and here's the lower limit. And this is really important because certain investors, such as pension funds, insurance companies, etc., they're only allowed to invest in investment grade credit, okay? So continuing with the basic features of a bond, now we're moving on to maturity. And the maturity date of a bond refers to the date when the issuer is obligated to redeem the bond by paying the outstanding principal amount. The tenor is the time remaining until the bond's maturity date. Okay, so that's a key term highlighted in bold. And again, I always say go to the glossary and make sure you're up to speed on all these definitions, because you could get asked a question on what tenor is. And the tenor is the time remaining until the bond's maturity date. Fixed income securities with maturities at issuance, original maturity, of 1 year or less are known as money market securities. That's important. So 1 year or less is money market. Fixed income securities with original maturities that are longer than 1 year are called capital market securities. Okay. Although very rare, perpetual bonds such as the consols issued by the sovereign government in the United Kingdom have no stated maturity date. So that's one of the small factoids that sometimes likes to come up in practice questions. What is a consol? A consol is a bond issued by the UK sovereign government, and it has no stated maturity date. So let's do a quick practice question to check our understanding. A 10-year bond was issued 4 years ago. The bond is denominated in US dollars, offers a coupon rate of 10% with interest paid semi-annually, and is currently priced at 102% of par. The bond's A, tenor is 6 years, B, nominal rate is 5%, or C, redemption value is 102% of the par value. Okay, that was a nice practice question to get the brain working. A is correct. The tenor of the bond is the time remaining until the bond's maturity date. Although the bond had a maturity of 10 years at issuance, original maturity, it was issued 4 years ago. Thus, there are 6 years remaining until the maturity date. So that should be an easy question. if you understand what the definition of tenor is. A had to be correct right away. Okay? B is incorrect because the nominal rate is the coupon rate, i.e. the interest rate that the issuer agrees to pay each year until the maturity date. Although interest is paid semi-annually, the nominal rate is 10%, not 5%. Okay, that's important to understand. C is incorrect because it is the bond's price, not its redemption value, also called principal amount, principal value, par value, face value, nominal value, or maturity value. So you see, this is one of the issues with regards to finance and the English language, and bonds in particular, is that we have many different terms that can mean the same thing. Okay, so that's why that, maybe I should highlight that in red, but principal amount, principal value, par value, face value, nominal value, maturity value, that's 6 terms all meaning the exact same thing. Okay, and that is equal to 100% of 102% of the par value. So it's the bond's price is 102%, not the redemption value. The redemption value is the par value. Nice little question. So now we're moving on to the par value, covering the basic features of a bond. And so as we said, the principal amount, principal value, or simply principal of a bond is the amount that the issuer agrees to pay the bondholders on the maturity date. This amount is also referred to as the par value, or simply par, face value, nominal value, redemption value, or maturity value. Okay, so bonds can have any par value, but a lot of times in the practice questions you can see that we're using $1,000. Okay, so in practice, bonds are quoted as a percentage of their par value. So and this is important to understand, for example, assume that a bond's par value is $1,000. A quote of 95 means that the bond price is $950. Okay, 95% times 1,000. And that's why also be careful in certain practice questions. A lot of times we use $1,000, but you'll also see sometimes $100 being used. Okay, so you need to be a little bit careful. The quote is in percentages, not in terms of dollars. Okay, so when the bond is priced at 100% of par, the bond is said to be trading at par. If the bond's price is below 100% of par, then the bond is trading at a discount. Alternatively, if the bond is priced 100% of par, the bond is trading at a premium. Now don't forget, we did a pretty good job back in the accounting section when we had to determine the initial recognition, initial measurement, and subsequent measurement of bonds. We covered all the accounting for a bond that is issued at par, issued at a discount, or issued at a premium. So that, again, this should not be new to us. So now we're moving on to coupon rate and frequency, talking about the basic features of a bond. And the coupon rate, or nominal rate of a bond, is the interest rate that the issuer agrees to pay each year until the maturity date. The annual amount of interest payments made is called the coupon. A bond's coupon is determined by multiplying its coupon rate by its par value. So for example, a bond with a coupon rate of 6% and a par value of $1,000 will pay annual interest of $60. 6% times 1,000. Now, if the frequency was semi-annual, that would be $30 every 6 months. Okay. All bonds, whether they pay a fixed or floating rate of interest, make periodic coupon payments, except for zero coupon bonds. Such bonds do not pay interest, hence their name, zero coupon. Instead, they are issued at a discount to par value and redeemed at par. They are sometimes referred to as pure discount bonds. The interest earned on a zero coupon bond is implied and equal to the difference between the par value and the purchase price. For example, if the par value is $1,000 and the purchase price is $950, the implied interest is $50. So let's do a practice question to consolidate our understanding. An analyst has gathered the following information provided in the table below. So we've got the period, the years, the U.S. Treasury spot rate, and the credit spread. Based on the information provided in the table, the current market price of $1,000 par value option-free 0% coupon corporate bond maturing in 5 years is closest to A, $758.70, B, $781.20, or C, $804.44. Okay, I like this question because it brings up a couple of points that you really have to pay attention to. Often like to see questions on zero coupons, okay? So you can see what the question was asking is based on the information provided in the table, the current market price of $1,000 par value option free 0% coupon corporate bond maturing in 5 years is closest to what? Okay, so there's a little trick here. Even though it's zero coupon, when we do our calculations for zero coupons, we still use semi-annual discounting. Okay, so that's not a mistake. That is 100% correct. So all we're doing, because a zero coupon is bought at a discount and matures at par, all we're doing is a present value calculation. And here it was for 5 years. So you can see also is giving the U.S. Treasury spot rate plus the credit spread. So it's going to be 5.6% is the rate that we need to discount because it's for a corporate, it said. But then because we're going to use the semi-annual discounting, we're going to divide by 2. So we're doing 2.8%, but for 10 periods, okay? So that's not a mistake. So if we just do the algebra there, it's 1,000 divided by 1.028 to the power of 10 equals 758.7, okay? So as I said here, it's just a present value of $1,000, bought at a discount, no cash payments. Can check using the calculator. So I'll just bring up the calculator. And if I do second PY, I'm here in periods per years 1. I got to change that to 2. So I'm going to do 2, enter, and then clear, okay? So then I'm going to do 1,000 on my future value. No doubt about that. There's no payment because it's a zero coupon, okay? And the interest rate per year is going to be, I don't need to adjust it because I've checked my parameter, is going to be the 5.6%. And the N is going to be 5 second NN. Okay, so we're going to compute the present value, and it's going to be 758.69. So the correct answer is A. All right, so 2 ways of doing that. One is just the easy algebra, which is present value equals future value over 1 plus I to the N. But the trick here, even though it's zero coupon, even though they're giving you 5 years, is that you had to adjust the I and you had to adjust the N, okay? And if you use the calculator, set the parameter PY equals 2, N equals 10, IY equals 5.6. We don't adjust it because we adjusted the parameter. Payment equals 0, future value 1,000. Compute the present value, and you've got the correct answer. Very nice practice question. Brings up a very important point with regards to the calculation of zero coupon bonds. As I sometimes like to do, I do another practice question following up on pretty much the same topic just to reinforce the key points here. So here's another one. The market value of an 18-year zero coupon bond with a maturity value of $1,000 discounted at a 12% annual interest rate with semi-annual compounding is closest to A, 122.74, B, $130.04, or C, $192.86. So in this question, they were nice enough to tell you that it's semi-annual compounding in the question. Okay, so you can see in this question, they told us to use the semi-annual compounding. So again, this is just straight out exact same as the previous question. You're just doing present value equals future value over 1 plus I to the N. And you can see that it's using semi-annual compounding. So it's N equals 18 times 2 equals 36. And our I is going to equal 12% divided by 2 equals 6%. Okay, so you can see the algebra. 1,000 divided by 1.06 to the power of 36. We get 122.74. But I wrote here the easier way. I always like to use the time value money functionality on the calculator. I just find it a lot easier. So again, I just need to make sure though second and check my that I'm in the 2 periods per year. So we're just going to follow, and I'm in the end mode, not in the beginning mode. Haven't done an annuity question just before. So again, I can do 18 second and N, gives me my 36 right away. Interest rate, I don't need to adjust, 12%. and there's no payment, and it's 1,000 on the future value, and I'm going to compute my present value, and 122.74, so the correct answer is A. Okay, so again, just wanted to reinforce the point that when we're doing the calculations for the zero coupon bonds, we're still using semi-annual compounding. Using the time value of money functionality on the calculator, calculate bonds should be easy. Nevertheless, with regards to the zero coupons, it's just because there's no payments, you can do the straight out present value equals future value divided by 1 plus I to the power of n. Okay, this question should be fairly easy. It says least likely exposed to reinvestment risk. What is reinvestment risk? It means that I get a coupon payment, or my bond is called by the issuer, and it means suddenly I have some cash that I need to reinvest, but interest rates have gone down. Okay, now clearly that can happen. You don't have any reinvestment risk over the life of a zero coupon bond because you're not getting any payments. Okay, now of course when the zero coupon bond matures, you'll have the cash and you'll have to reinvest it. But with regards to this question, the zero coupon bond is least likely to be exposed to reinvestment risk. Callable bond, yes, because A, you're getting coupon payments, plus if interest rates go down, the bond could be called. Amortizing security, sometimes I'm not even sure what they're meaning by that term. They like to do that on the CFA exam sometimes, give you some new terms, and sometimes you think you don't know what you don't know. Maybe you've missed something. Honestly, C is wrong. Anyhow, sometimes you just have to know that you're most right with B. Don't doubt yourself. Go with what you know. Okay? So B is correct because there's no interim cash flows for a zero coupon bond until maturity. So continuing with our basic features of a bond, now we're going to look at coupon rate and frequency. Okay? So a plain vanilla bond or conventional bond pays a fixed rate of interest. In this case, the coupon payment does not change during the bond's life. However, there are bonds that pay a floating rate of interest. Such bonds are called floating rate notes, FRNs, or floaters. The coupon rate of an FRN includes two components, a reference rate plus a spread. The spread, also called the margin, is typically constant and expressed in basis points. So that's an important point. It's going to come up later. So the spread is set when the bond is issued, and it's fixed. Okay. So if there's going to be an increase in a coupon payment, it's because it's the increase in the reference rate. So if the floating rate note is tied to LIBOR, if LIBOR increases, then the coupon will increase. The coupon is not going to change because of a change in the spread. The spread is fixed. Okay. So the next point to bring up here is that a basis point, so again, the spread, also called margin, is typically constant and expressed in terms of basis points. So a basis point is equal to 0.01%, but put another way, there's 100 basis points in 1%. So what I always do is I go like this, 0.01, that's my 1%, okay? And that's 100 basis points. So I know that's 1 basis point, okay? That would be 0.0001. I know that this would be 10 basis points, so that would be 0.001. And of course, I could get to 99 basis points, so that would be 0.0099. And if I get to 100 basis points, 0.0100, that's my 1%, my 100 basis points. So just make sure that you get your zeros right with regards to the basis points, okay? That's the way that I do it. 100 basis points is 1%. So write it out, just, if they say 10 basis points, 15 basis points, 50 basis points, just make sure that you get your decimals right, okay? So for example, assume the coupon rate of an FRN that makes semi-annual interest payments in June and December is expressed as the 6-month LIBOR plus 150 basis points. Well, we know that's going to be 1.5%, 150 basis points, okay? Suppose that in December 2000 XO, the 6-month LIBOR is 3.25%. The interest rate that will apply to the payment due in June would be 4.75%, which is the 3.25% plus the 1.5%, okay? So again, with regards to a floating rate note, the spread is held constant. The coupon rate changes as a result of a change in the reference rate. And again, get your basis points correct in terms of the decimals, the number of zeros. So let's do a practice question to consolidate our understanding on that. A company has issued a floating rate note with a coupon rate equal to 3-month LIBOR plus 65 basis points. Interest payments are made quarterly on 31st of March, 30th of June, 30th of September, and 31st December. On 31st March and 30th June, the 3-month LIBOR is 1.55% and 1.35% respectively. The coupon rate for the interest payment made on 30th of June is A, 2%, B, 2.1%, or C, 2.2%. Okay, this is a little bit of a tricky question, but as I often say, fool me once, shame on you, fool me twice, shame on me. So what have they done? They've given us March, they've given us June, and they've given us September and December. Sometimes I write these out. You do have 90 seconds, okay? So they're giving us the rate here, the LIBOR rate, 1.55% and 1.35%, okay? Now they're asking for what the coupon rate for the interest payment made on 30th of June, this one. So again, right off the bat, we don't need anything with regards to September, December. Now the little trick here, are we going to do 1.35% plus 0.65? If we do that, let's bring up the calculator. 1.35 plus 0.65, we would have 2%. Oh, the correct answer is A. No, that is not right, because this is, again, these are the factoids that you need to know and learn. The coupon rate that applies to the payment on 30th of June is based on the 3-month LIBOR prevailing on the 31st of March, okay? So that is the trick that once you've seen it once, you won't be fooled again. We're not going to use the 1.35%. We're going to use the 1.55%. So bring up the calculator. And again, this should be easy. If you know the rule and you see a question like this, you know, aha, they're doing this type of trick. 0.65. See, that's not a 90-second question. The correct answer is 2.2%, okay? So the trick here was to know that when you're looking at a floating rate note and they're giving you some rates, that the rate applies on 30th of June was the LIBOR rate prevailing on the 31st of March. So this is a very important question, brings up a very important point that once you know it, the calculation is very easy. But if you don't know it, then you're kind of guessing, is it A or is it C? Because if I do the calculation both ways, both answers are there, okay? No, the correct answer is C. We use the rate prevailing on March 31st to calculate the coupon payment for June 30th. Excellent question. So now we're going to look at currency denomination with regards to the basic features of a bond. And a dual currency bonds make coupon payments in one currency and pay the par value at maturity in another. Okay, so that's important to understand. Dual currency bonds, coupon payments in one currency, pay the par value at maturity in another. Currency option bonds can be viewed as a combination of a single currency bond plus a foreign currency option. They give the bondholders the right, but not the obligation, to choose the currency in which they want to receive interest payments and principal repayments. So carrying on with the basic features of a bond, now we're going to look at yield measures, and there's some important terminology here. The current yield or running yield is equal to a bond's annual coupon divided by the bond's price expressed as a percentage, okay? So the current yield or running yield, you just take the coupon divided by the price. And as we know, the price of a bond can change. The most commonly referenced yield measure is known as the yield to maturity, also called the yield to redemption or redemption yield. The yield to maturity is the internal rate of return on a bond's expected cash flows. That is the discount rate that equates the present value of the bond's expected cash flows until maturity with the bond's price. Now, forget about the English language there. All that is saying is that if we're given a bond's price, we know the present value. And of course, we know the future value. That's the maturity value. We know the payment, it's a coupon payment. Unless it's a floating rate note, it doesn't change. And we know N, which is the time until the bond is maturing. So when we solve for IY, that is giving us our yield to maturity, okay? And we've seen that before with regards to the cost of capital. With regards to the bonds, we calculate the yield to maturity, and that's the cost of our debt, okay? So that should not be too new to us, okay? So the yield to maturity can be considered an estimate of the bond's expected return. It reflects the annual return that an investor will earn on the bond if this investor purchased the bond today and holds it to maturity, okay? Now there is a assumption there that the interest is being reinvested at the same rate. Nevertheless, so there's an inverse relationship between the bond's price and its yield to maturity. We know that. If interest rates go up, bond prices go down. That's an inverse relationship. If interest rates go down, a bond's price will go up. All else being equal. That is, the higher the bond's yield to maturity, the lower its price. Alternatively, the higher the bond's price, the lower its yield to maturity. Thus, investors anticipating a lower interest rate environment in which investors demand a lower yield to maturity on the bond hope to earn a positive return from price appreciation. Now, as we know, if we buy a bond and we hold it to maturity, we're not going to have any capital gains or losses. But during the life of the bond, as interest rates changes, we will have capital gains or losses. So we'll do a quick practice question to check our understanding. Which of the following is most likely a limitation of the yield to maturity measure? A, it does not reflect the timing of the cash flows. B, it assumes coupon payments can be invested at the yield to maturity. C, it does not consider the capital gain or loss the investor will realize by holding the bond to maturity. Okay, B is correct because yield to maturity does consider reinvestment income. However, it assumes that the coupon payments can be reinvested at an interest rate equal to the yield of maturity. And that's one of the things that I mentioned in the previous slide, okay? This is one of the limitations for the yield to maturity measure because the investor is facing reinvestment risk. Future interest rates could be less than the yield to maturity at the time the bond is purchased, okay? So a nice little question just to check your understanding on yield to maturity measure and the fact that it assumes that interest is being reinvested at the same rate. Okay, we're going to finish this LOS with two quick little practice questions that fall under the category of factoids, you know, small things that you may need to know, nice to know, nevertheless sometimes buried in the curriculum. So let's do the first one. The yield on U.S. Treasury strips security is known as the Treasury A spot rate, B yield spread, or C forward rate. So this is an important factoid to know. The yield on U.S. Treasury strips is known as the Treasury spot rate, okay? A is correct because a strip security is a zero coupon bond with no default risk and therefore represents the appropriate discount rate for a cash flow certain to be received at the maturity date for the strips. So again, a fairly important factoid with regards to what the spot rate is. Okay, I'm just taking a quick screenshot of the glossary from the ebook, and I've said this before and I'll say it again. It is possible if you don't have a paper copy, if you're just using the ebook, one of the things that I recommend is that you copy and paste it into a Word document, print it out, and make sure you review the entire glossary, okay? Because things, the CFA exam, a lot of it is English language tests, subject accounting, subject ethics, subject in this case bonds. So you can see here the definition of the spot curve is a sequence of yields to maturity on zero coupon bonds. There it is, sometimes called zero or strip curve because coupon payments are stripped off the bonds. So it's important to understand what the spot curve is. Spot markets are markets in which assets are traded for immediate delivery. Spot prices are the price of an asset for immediate delivery. And here we get to the spot rates, which says a sequence of market discount rates that correspond to the cash flow dates yield to maturity on zero coupon bonds maturing at the date of each cash flow. Okay, so again, very important to understand all the terminology definitions in the glossary. And one last practice question to finish this LOS. An investor is evaluating a diverse set of bonds from which he will select two issues. The investor's objective is to find bonds with cash flows that will precisely match a known stream of future cash outflows. The pair of bonds most likely to meet the investor's objective is A, a puttable bond and a callable bond, B, zero coupon bond and a treasury strip, or C, a mortgage-backed security and an asset-backed security. Nice little question to end on. The correct answer is B. Both the zero coupon and treasury strip bonds have cash flows that can be estimated with certainty. And that's the last slide for this LOS. Thank you.